Mark, you're a busy man, and we've finally managed to pin you down here in beautiful Te Pai, where you're hosting our Craig's Investor Day later today. So we thought before the crowds arrive, we'd catch up with you and just get a few thoughts from you on what you're feeling about markets at the moment. And I'll start with, I guess, the year so far, because it's been a pretty volatile ride. What do you make of it, and how are you feeling about it, so far through 2025?
Yeah, it's been a difficult start to the year. I think we all knew that with President Trump entering his second term, there would be lots going on, as there was during his first term, and he's delivered in terms of volatility and lots of ups and downs. So tariffs and trade tensions have been what has really rattled markets, and we saw some announcements in early April about potential tariffs, proposed tariffs on everyone, really. Since then, there has been some backtracking, some negotiation. So it's been a real roller coaster. We saw markets fall, then we saw them rebound. We've seen weakness in the US dollar. We've seen higher interest rates in parts of the world as people think about the potential implications of more borrowing, more debt. And it's been a very volatile period for investors so far.
Yeah, and it does feel like we've had so much condensed into 4 or 5 months in markets. Do you think that's sort of set to continue for the remainder of the year, where we're just going to get lots of news flow and markets are going to move quite quickly on the back of that?
Yeah, I think it will be par for the course. And as unsettling as that is, we've got to keep in mind that it is normal. These sorts of drawdowns, these sorts of declines, they do come very frequently. And even in the good years, 3 out of 4 years historically for the share market will be up years. But even in those years, you often do see these big moves, and you see those drawdowns of 5%, 10%. They're not unusual. So we've just got to remind ourselves that we are investing for the long term, and over shorter periods, that volatility, that uncertainty is par for the course.
Yeah. And that US market, if we think back the last couple of years prior to sort of 2025, it has been a darling market. It's been really strong, hasn't it? So, where's it landed so far this year, and what do you make of that?
That's a really important point you make, because the US share market was up 25% last year and 25% the year before that.
Right.
So it's had 2 cracking years, driven by tech, driven by AI, the Magnificent Seven, and so forth. So it started the year at quite a high point in terms of valuations and so forth. Then you had Liberation Day and the tariff announcements, and we saw a fall of about 19% from top to bottom. So a big fall. Since then, it's recovered, and it's about back to even or thereabouts. So it's sort of flat on the year. Interestingly, we haven't seen as much volatility elsewhere. So other markets around the world did fall when the US did. But the likes of Europe, as an example, still up 10% this year. So we've just got to put it in perspective that the volatility we've seen in the US has come after 2 cracking years, and that's sort of understandable. Other parts of the world have been less volatile, and there are still some markets that are performing very well. So if you're well diversified, you've got a good spread, you're probably not doing as bad as some of those media headlines might suggest.
Yeah, and I guess one of the things that maybe is driving that volatility in the US market more so than others is this talk of potential recession, and it's obviously the biggest economy out there. So where are you at in terms of your expectations of recession or risks or slowdown?
Yeah, really difficult to know what will happen, because we don't know how far the US president and his team will push it in terms of the tariffs, and where we'll see negotiations, when we'll see sort of potential backtracks and deals being done. It is a risk to growth, and it is the United States that will ironically feel the brunt of that, because the tariffs are essentially a tax on US consumers, and the US consumer is 2/3 of the US economy. So there are recession risks. A recession is far from inevitable. I think most of the estimates are sort of maybe there's a 30, maybe even as high as 40% chance potentially, which is high, but there's also a good chance that the US just has a slowdown and avoids recession. Even if the US does fall into a recession, it would be different to many of those periods we've seen in the past, because it would be a policy-induced recession, which makes it quite different. And there's a good chance other parts of the world would maybe slow down but not be hit as hard. So all of this is speculation. We don't really know. I think as investors, all we can do is prepare for that and position our portfolios to mitigate some of those potential risks while also taking opportunities, because there's definitely some positive signs out there as well, and there are still good things happening in the world that we need to take advantage of.
And you talked about sort of some of those mitigating steps you can take, and it feels like, when other markets are actually doing okay at the moment, we're not super confident what Trump's next move is going to be. I'm not sure he is either, but it feels like then diversification is one of your big safety nets. Is that how you sort of see it?
Oh, 100%. Whenever there's uncertainty, diversification is your biggest ally. So I think that means you want to have a balance of asset classes. So you still want to have your solid defensive asset classes like your good quality fixed income. Within your shares, part of your portfolio, you want to be well diversified across different parts of the world, and not just in the US, not just in tech. Have some Europe, have some Japan, have some UK, New Zealand, emerging markets, be well spread, and have a good spread of sectors. We know that during economic slowdowns, sectors like healthcare, sectors like consumer staples, here in New Zealand, it's utilities, it's infrastructure. Those sorts of assets prove to be more resilient, and alternative assets too. That's a part of the market that provides an additional layer of diversification. So really important.
One that people forget about, isn't it? That private equity, alternative assets, everyone seems to think traditional equities, but there is this other asset class out there, which is fantastic, isn't it? When you are trying to get that diversification and sort of spread that risk a bit more.
Yeah, that's right. And if you look at the wealthiest families in the world, the uber rich, they will have 10, 20, 30% of their portfolio in alternative assets, which is a range of things. That can be private equity, it can be private debt, it can be infrastructure, it can be a whole lot of different things, gold, commodities. The smaller investor doesn't typically invest in those sorts of things as much, but it's maybe an opportunity for smaller investors and the rest of us to take a leaf out of the book of some of those very successful, very wealthy investors around the world and add that string to our bow.
Sure. And then if we bring that a bit closer to home to New Zealand here, the tariff stuff, the uncertainty going on, what does that mean for us sitting here in New Zealand?
Well, the good news is we're not directly in the firing line. So we are a little bit under the radar, which is fantastic. However, the US is the world's biggest economy.
Yeah.
And if they slow down or enter recession or whatever, everyone will be impacted. So for us, I'm thinking more about those indirect effects. You've got China, that's our biggest trading partner, takes 25% of our exports now. And the US is number 2, actually, at about sort of 12 or 13%. So if those two countries, the two biggest in the world, are at loggerheads in terms of trade tensions and policy and so forth, and it impacts both of those economies negatively, that will impact New Zealand because we sell a lot of products to those places. So those are the sorts of things we need to think about.
Yeah. And we've just recently had another Reserve Bank meeting, another cut. So remind us where we sit now and where the market sort of is expecting rates to go over the next, say, 6-12 months. And then what else is going well for us? I see a lot about commodity prices. That must be doing some good stuff for the economy.
Yeah, lots of good things happening and lots of positives we can focus on. So another OCR cut, we're at 3.25% now. That's down from 5.5% middle of last year. That was the highest in 15 years. So it's been a big fall, more than 2%. And that will make a huge difference to many household budgets, because I think if you think about sort of your mortgage rate, a year ago it was north of 7, now it's sort of sub 5. If you've got that typical $600,000 mortgage, it's probably about $800, $900 a month of additional income you have in your pocket that you're saving on the interest bill. So that will make a big difference. Where the OCR goes from here, I think there is another cut or two still to come, but probably not much more than that. So we might go to 3%, we might go to 2.75%. To go lower, you'd probably have to see a sharper slowdown and higher unemployment, which we don't want. But put all that together and it provides quite a positive outlook for the local economy. Agriculture as well, you've got the dairy sector, a $10 payout in the season just finished, the highest of all time. And Fonterra has just announced the opening forecast for next season. That's $10 as well. So back-to-back $10 payouts, fantastic for rural New Zealand.
Yeah.
We've got business confidence that is holding its own and telling us that businesses are a bit more optimistic about the future. So after 2 years of recession, I think the second half of this year will be much better than we've seen, and we can look ahead to a much stronger 2026 as well.
And those interest rates coming down, I know one thing that's always of interest to me is the housing market and where that goes. Surely that big cut we've had from 5.5 down to 3.25, those mortgage holders feeling a little bit less pressure. Does that flow through, do you think, to the housing market, which has been sort of just bouncing along for the last 12, 18 months? Does that start to see some life soon, do you think?
Yeah, I think there are some positive signs ahead for the housing market. And, personally, I'm optimistic. I'm glass half full in terms of where the market will go. I think it's a good time to buy a house. But at the same time, I'm conscious that affordability is still not on our side. We did see a big fall from the peak in late 2021 to sort of where we're at now. Prices fell 15, 20%. That's a big fall. But we've just got to remember that in the 2 years leading up to that 2021 peak, prices rose almost 50%, which is crazy. So prices are still much higher than they were pre-COVID, and you still haven't got high affordability. So good time to buy a house, but if you're an investor, my advice will be just sort of keep your expectations grounded. The long-term average in terms of house price growth in New Zealand is about high fives, just shy of 6%. I would be assuming something around that level rather than getting excited that you might see 10% plus gains per annum. I don't think we'll see a return to those days.
Yeah, right. So put all that together and how are you feeling about it from let's take a new investor point of view, and you've got some money, you're wanting to put it into the market. Does it feel like a good time, and where are you sort of most excited about in those pockets of the market at the moment?
Always a good time to invest, but you always want to sort of take a cautious approach. We never know what's around the corner. There's always risks.
Yeah.
At the moment, it's US policy changes and so forth, but there's always something. So if you're waiting for a time when there's no risks and it's just full steam ahead, you'll be on the sidelines forever. So you've got to take some action. I think fixed income looks attractive at the moment. You're still going to see interest rates come down further. It'll give you predictable income and a steady income stream. So that's an area that I think you want to anchor your portfolio with. In terms of equities and shares, look, I like the local market. It hasn't fired for the last few years, but we've got some great businesses, high dividend yields, very tax efficient. I can see a recovery ahead. So I'm very comfortable with all of those great New Zealand businesses. And internationally, look, the world is your oyster and there are lots of opportunities. Periods of volatility do bring times when you can pick off some good stocks when they're at sort of beaten up prices. So keep an eye on those opportunities, take them, just make sure you're well diversified across sectors, across regions. The last 2 years it's been very easy in hindsight to just sort of invest in US tech and be done with it. I don't think we can do that anymore. We've got to be a bit better spread and think a bit more carefully about different regions, different economies, different markets. And as we mentioned early on, sort of think about some of those other asset classes that you might sort of put into that alternatives bucket. Talk to your advisor about opportunities there.
Yeah. And I guess when there is this volatility, it always feels a bit scary, doesn't it, to sort of step into the market. But like you say, that's when you can pick up some bargains, some real opportunities out there. So, plenty to think about, and great to catch up with you, Mark. So thanks for taking the time. I know you got a big day today and a big crowd to entertain. So we'll wrap it up there and leave you to your day.
Yeah, thanks, Mark. You've got to help me host this too, so you're not of the host.
Absolutely, I will.
All right. Thank you.